The first quarter of 2024 is in the books. What happened here locally when we're discussing multifamily property values, sales, rental trends, and all the rest? We have all that information. Stay tuned. Hi, this is Kris German, and welcome back to the Apartment Dealer Show. Today we have for you our recap of the first quarter of 2024, what happened in the world of multifamily real estate. We're going to discuss and analyze the most recent sales trends, rental rates, and this is the information that I'll share with you. Okay, where are we in terms of the market cycle? Now, when we're coming out of 2023, which was a rough year for multifamily properties, it was not a very impressive year. And so sales were slumped. We saw prices begin to decline, cap rates move up. Is that trend continuing? We're going to break down the individual areas that we service, my team and I service here in Southern California. And we're going to discuss the recent sales. Again, first quarter in a nutshell. We're also going to discuss the rental rates and where are rental rates currently. But to make sure this video is for you or speaks to the information that you're looking for, let's discuss what are the geographic areas that we're going to cover. We're going to discuss the East Los Angeles corridor, 710-91 corridor, West San Gabriel Valley, East San Gabriel Valley, 605 corridor, the Pasadena corridor, Inland Empire West, and Inland Empire East. Now, what does that mean? Well, we have taken our map of service, if you will, and we chunk it down into these individual corridors. Why do we break it into these individual corridors? Because the prices, rental rates, and tenant base is about the same in the cities that we lump together. So let's be more specific. In East Los Angeles, we have Boyle Heights, East LA, El Sereno. The 710-91 corridor, we have Bell Gardens, Commerce, Cudahy, Huntington Park, Maywood, Southgate. West San Gabriel Valley, Rosemead, San Gabriel, Temple City. East San Gabriel Valley, Azusa, Balboa Park, Covina, El Monte, Glendora, Laverne, Monrovia, South El Monte, West Covina. Pasadena, Sierra Madre, South Pasadena, Inland Empire West, Chino, Claremont, Montclair, Ontario, Pomona, Rancho Cucamonga, Upland, and Inland Empire East, Bloomington, Colton, Fontana, Rialto. The information I'm going to discuss here in this video speaks to those areas. If you're not interested in those areas, this may not be specifically for you, but these are our coverage areas. This is the areas that we speak to and know best. Again, if you own in any of these particular cities or are curious about one of the cities that I mentioned, this is a good starting place. This is the information that you need. Now, before we get into the specifics, let's discuss the market at large. What are some things going on in the market? I'll notate here that I've recorded an additional video that you're going to want to check out. 7 considerations for multifamily investors. There's 7 very important considerations that I just literally stepped off stage and discussed at my recent Apartment Owners Educational Luncheon, and which served as the overarching theme for the attendees. That breaks down, again, the most important items. But I'm going to pull from that, discuss a few here that you need to be aware of, I think, that are particular to this market update video. Number 1, interest rates. Now, interest rates have gone up. Well, when it comes to multifamily properties, the interest rates are tied very closely to what happens within the Treasury market. Well, if you look at this recent article, Treasuries have gotten harder to sell. What does that mean? They have to offer a higher yield in order for Treasuries to move. And the higher yield on the Treasury means that it pushes interest rates up because the interest rates are typically a margin above what the Treasuries are trading for. So here, just 2 weeks ago, the 10-year Treasury hit 4.63%. You say, okay, well, what does that mean to you? Well, the last time it hit 4.63 or something close was in the fall of 2007. Anybody know what happened after the fall of 2007? And that's when we had the financial market collapse. Now, I'm not suggesting we're going to have a financial market collapse, but please understand that interest rates are up. That's serving as a test for the commercial market. This year alone, there's about $860 billion worth of commercial debt that's coming due. And the banks are already struggling with negative commercial debt on the books. And so this is something to be cognizant of. What's that going to mean to the market going forward? Because next year, there's even more debt. 2025, there's even more debt that's going to come due. So for these individuals who say just a few years ago, locked in a rate of 3.5%, 3%, and now the loans readjusting to say 6.5%, 7%. For some folks, I've been told 8% and 9%, depending on the margin that their loans tie to. That is a significant jump in your mortgage payment. What did that just what just happened there? Well, now your cash flow just took a significant hit. So this is one of the underlying issues for commercial real estate as a whole, multifamily more specific. Is that going to bring more inventory to the market? Because the more inventory that's brought to the market, and especially if they're sellers that are, we'll call them highly motivated, right? And so now those sales, if they reduce the price or look for prices to move properties very quickly, that'll have an impact on values, that have an impact on the value of property. That's something that we have to watch going forward. Second, I thought I'd share this interesting chart with you. So this chart essentially tracks when we're talking about population movement, where individuals, what areas are receiving individuals and which areas are bleeding individuals. Well, you see, for example, the Inland Empire. The Inland Empire is the recipient of many, many folks that are relocating, looking for affordability and more space and what have you. And we look all the way to the right and we see Los Angeles County is bleeding a number of folks. So this is interesting when we take a look at just the overall trends in population, or if I'm a multifamily investor, where should I be looking? You know, we've discussed the Inland Empire for many years on this channel. And so we've sold many, many apartment buildings, or represented landlords, I should say, in the Inland Empire for a number of years. And it's an area that we know well. And that's an area that you should be looking at, especially what is that, you know, if the population grows, there's only so many rental units. That means there's less supply, more demand. That makes good for rental rates and property values. And then lastly here, we'll share with you the projected rent growth that we're going to see over the course of 2024. Now, let me preface it with this. Up until about February of this year, we had seen negative rent growth. So rental rates had been pulling back. Now, in part, that was due to the fact that in 2020, 2021, 2022, we saw historic gains in rental rates. So the fact that they would pull back should not be a surprise. It's not alarming and it is the saying anything catastrophic is going to happen in the market. But just be aware that we're not seeing those same gains that we saw over the course of those 3 years. They've pulled back. They were in negative growth. And now we're showing a slight hope that they'll move into positive. And if we look at, say, if we're looking for Los Angeles, well, we might see a whopping, according to the statistics here, a whopping 1% growth in rental rates. And of course, that's Los Angeles as a whole. But you see, say, versus other areas like Riverside, they'll see as high as a 3% growth in rental rates. And that's another area that, investors should be looking at. So I thought I'd share this chart with you. Again, we need to be aware of what's happening on the ground with respect to rental rates, because our property values are tied to the income that they collect. Hence, we need to know, okay, well, what's the overall trajectory? Now, let's get into the specifics of what has happened over the last 3 months. Some things to note. Number one, this video is chopped up into individual chapters. The individual chapters are corresponding to me covering the different geographic areas. So if one area doesn't speak to you, you can skip to those areas that do. Number two, again, these are only the sales from January 1st to the end of March. So you'll see some areas didn't have very many sales. And sometimes the numbers are skewed because if there was, say, a outlier type sale that sold for a very high price given certain dynamics of the sale, well, when you're dealing with not that much data, that can skew the numbers, and vice versa. Let's say if there was a distressed sale, that can skew the numbers the other way, especially when we're dealing with not that much data given only 3 months worth here, just to note. Third and final point when we're talking about the data. The data that I'm going to share, we pull from CoStar. CoStar is a third-party independent organization, and they make their living by gathering the statistics with respect to the commercial real estate market. No affiliation. We utilize their data because they're the best in the business. They do this nationwide for all different product types. So these sales that I'm going to cover, while I was involved in several, again, these are not just my sales. These are the sales for the total market. And when we get into sales volume and the average cap rate and price per unit and GRM and so forth, we're relying on that information or the information that was shared from the agents involved in those sales. They shared it with CoStar. CoStar made that public record. So that's the data that we're going to be sharing with you. So let's start with the area, the East Los Angeles corridor. In the first quarter of 2024, we had a whopping 2 sales for a total sales volume of $2.4 million. The average price per unit of those 2 properties that sold was $202,000, almost $203,000 per unit. The average cap rate, 4.34%. Now, I will tell you that's on the low end, and this is one of the issues when you don't have that much sales data. I would argue that in East Los Angeles, in order to get a property to move these days, you're going to have to be over a 5% cap rate, unless there's some other circumstances, but in general. But for at least these sales, that's where the numbers come in. The average GRM, 19.94. Again, I would argue in East Los Angeles, you have to be at least less than a 14 GRM. So maybe there were some vacancies here or what have you. Again, we're at the mercy of the data that was shared by the agents involved in these particular sales. Yet 2 buildings sell out of a total of 690. There's a total of 690 buildings in the East Los Angeles corridor. But again, it's only 1 quarter worth of data, and the market coming out of 2023, of course, has been a little bit on the slow side. We always like to notate, one of the sales that occurred in that quarter, typically say the highest price per unit or something, that stands out a particular sale. Here in El Sereno, this 5-unit property sold for $1.1 million, $220,000 per unit. And one of the things that led to that price per unit is at the time of sale, there was 1 vacant unit. And that means a lot, especially when we're talking about rent control, because the buyer, I assume, looked at that unit with optimism that, hey, I'm going to close escrow and then I can, remodel that unit and bring that unit to market rent. And so that makes a difference, especially when a lot of these properties that are being sold, the previous owners were not very proactive with the rental rates. And so vacancies really are a blessing as a buyer today, again, in the land of rent control. And so I'm sure that also was a part of, the buyer determining value here. Now we have all the rental rates from studios to 3-bedroom units. You can pause the video here, find the unit type of your choice, but these are the averages as of the first quarter 2024. The 710-91 corridor. In the first quarter 2024, we had a total of 7 sales. That amounted to a total sales volume of $11,335,000. The average price per unit of those 7 properties that sold was $220,000. The average cap rate was 4.76%, which is promising because I would argue the average cap rate in the market today is 5.25%, even higher in some cases. And so the fact that on average these sold below the norm, that means that on average the prices were selling at a higher value, right? There wasn't as much income in those properties. The average GRM, 12.53. That's about what I would expect. And these 7 sales were out of a total stock of 2,467 buildings. The sale that we'll notate in this corridor was the 6-unit property that sold on Santa Ana. If you're familiar with Santa Ana Street in Cudahy, there's a lot of these type of properties where there are big lots, single-story construction, very desirable if you're an investor. And this particular property sold for $1,850,000, $308,000 per unit. And this property was just that, single-story units, cottage-style units. And several of the buildings were actually, because these were individual buildings, were actually built in the 1980s. So that, led to the higher price per unit. Now for the rental rates, you can pause the video here, find your unit of interest. These are the average asking rental rates as of the first quarter 2024. Let's move over to the West San Gabriel Valley. In the Western San Gabriel Valley, we had a total of 4 sales for the first quarter of 2024. That amounted to a total sales volume of 11 million, just under 500,000. The average price per unit, 308,000. The average cap rate, 4.12%. That's what I would expect in this area, maybe closer to say 4.5% cap rate, but within my expectations. And the average GRM, about 17, a little bit on the high side. I would have thought maybe 16.5, somewhere around there, but close enough. These 4 sales were out of a total stock of 1,926 multifamily properties in this area. The sale that we'll notate in this corridor is this 6-unit property that sold in San Gabriel, sold for $2.4 million, $400,000 per unit. Not cheap by any means, but it's one should note that this property was actually across the street from the San Gabriel Mission, number one. Number two, they were all 2-bedroom units, and San Gabriel is a very desirable city to own in, so always trends on the higher side when it comes to price per unit. And so this falls in line with that. Here are your rental rates for the Western San Gabriel Valley. You can pause the video, find your unit type of choice. And these are the average asking rents as of the first quarter 2024. The Eastern San Gabriel Valley, first quarter 2024, we had a total of 7 sales. The total sales volume for the first quarter was 28,500,000. The average price per unit, 293,000. So the Eastern San Gabriel Valley is doing quite well, even amidst the challenges in the market. The average cap rate, 4.82%. That means that sellers are still faring well in a market that I would say on average is closer to 5.25. Average GRM, 13.89. And the 7 sales were out of a total stock of 1,871 multifamily properties in this corridor. The sale that we'll notate here was 9 units over on Rio Hondo Parkway in the city of El Monte. Now, this property consisted of 2-story townhouse-style units, and those units were built in the 1980s. That's why you have the higher price per unit. Construction style, 2-story townhouses, very desirable. Newer construction, especially when people are having challenges getting property insurance and what have you. The newer constructed a building is, the less of a challenge you have when it comes to property insurance. Here are your rental rates for the Eastern San Gabriel Valley. Find your unit type of interest, and you'll find your average asking rent as of the first quarter 2024. Now let's discuss the 605 corridor. In the first quarter of 2024, we had a total of 6 sales. Those 6 sales amounted to $15,511,000 total dollars worth of sales. The average price per unit, $251,000. The average cap rate, 5.34. Average GRM, 11.98. All of these would be in line of what I would anticipate. The sale that we'll notate for this corridor, 8 units in the city of Norwalk, sold for $2,565,000. That is a big number when we're comparing it against the average price per unit was $250,000. Why is that? Well, this particular property had astronomical rental rates in place. So high that I don't know that they're achievable long-term. But again, I concede I don't know the property that well. Maybe the seller had done some extravagant capital improvements and so forth. And then, so, in that case, maybe they are achievable long-term. But the more income that a property brings in, the more it is worth. Hence, that seller, they did a good job raising their rental rates. And so they got a nice payoff for having done so. Now, here are your average asking rents for the 605 corridor. Find your unit type of interest, and this will share with you again what is the average asking rent as of today, first quarter for this particular area. Now, let's discuss the Pasadena corridor. For the first quarter of 2024, we had a total of 5 sales. That's out of a total stock of 1,634 buildings. Those 5 properties amounted to $17,100,000 total sales volume. The average price per unit, $378,000. The average cap rate, 4.48%. The average GRM, 16 or so. Now, the notable sale that we'll mention here was a 5-unit that sold over on Grand in Pasadena. sold for $2,725,000. That amounted to $545,000 per unit. And that's a big price tag, especially in light of the fact that we just said the average price per unit was $378,000. Why could that be? Well, this 5-unit property actually consisted of all single-story detached bungalow-style units, almost, if you will, 5 individual houses on one lot. And so that always lends to a higher price per unit. When it comes to construction style, typically, in terms of desirability, it goes single-story bungalows, like this particular property. Then maybe all single-story construction, but some of the units are connected. Then it would be 2-story townhouse-style units, like condo-style living. And then it would be your typical 2-story apartment building. So that, dictates value just as much as, say, rental income and some of the other items. Now, here are your average rental rates for the Pasadena corridor. Take a look at your unit of interest. And these are the average asking rents as of the first quarter 2024. Now we move into the Inland Empire. We'll start off with the Inland Empire West. We break up the Inland Empire West and East because it really is 2 different tenant bases. The rental rates differ. And so that's why we break up. We wouldn't just say the Inland Empire as a whole. In the Inland Empire West, we had a total of 2 sales. These 2 sales amounted to $3,120,000. The average price per unit was $180,000 or so. Cap rate 6.95% and 9.24 GRM. Now, these are all out of line. This is not typical of the average price per unit. So again, not having enough sales volume kind of shades the numbers, as well as the 6.95 cap rate. Do not say, okay, I'm going to just find a 7% cap rate deal in the Inland Empire West. You will be disappointed. No different than saying I'm going to find a deal at about a 9 GRM. Again, this is an anomaly. So Kris, what would be more of an average for the Inland Empire West? I would say somewhere around $250,000 per unit. Cap rate, say maybe around a 5.5, 5.75 cap. Average GRM, probably around 13 or so. That would be more in line with the averages that we've seen. But again, we're talking about just the first 2 sales of the year. Of those 2 sales, we'll notate this 6-unit that sold over on Pasadena Street, sold for $198,000. This 6-unit property also had a non-conforming unit, an illegal unit, if you will. So a 7th dwelling, while not legal, was collecting rent. And so I'm sure that went into the buyer's decision in terms of total value, because while you wouldn't call it a legal unit, obviously, as long as that unit is around, you're able to collect income. That changes things for you financially. Now, here are your average asking rents in the Inland Empire West. You pick your unit of interest, and we've essentially whittled it down to what are the averages for all the bedroom types. You can stop the video here and take a look at that. Now, the Inland Empire East. We had a total of 5 sales, and that's kind of uncharacteristic that the Inland Empire East would have fared better than the Inland Empire West. Usually it's the other way around. We would have seen more sales in the Inland Empire West. But again, we're just starting out the year. But those 5 sales amounted to $11,647,000 worth of sales. Average price per unit, $229,000. Cap rate, 4.7%. GRM, 12.68. The sale that we'll notate here was this 16-unit property that sold in Fontana, $286,000 per unit. Not a cheap price at all. Things to notate. Number 1, the unit makeup was 3-bedroom and 2-bedroom units. That obviously weighed in on the price. Property was built in the 1980s versus older stock. That weighed into the price, especially in light of the fact that the challenges we're having as apartment investors here locally, getting apartment insurance. The newer the building, the easier it is. The assumption that the electrical panels are the newer style, you're not dealing with Zinsco and Stab Block and some of the other brands where you cannot get property insurance. So, this building being newer also would have had copper plumbing, things like this. So that all, has a part in the value. Here are your average asking rents for the Inland Empire East. You can stop the video here, find your unit of choice. We've collected all the data for you. So all in all, we're off to a slow start, but last year was not a great year when it came to multifamily sales. Definitely the first quarter of this year is doing better overall, I would say in investor sentiment, sales volume, and all the rest, better than the first quarter of 2023. That's a positive. The three things, again, to be cognizant of what happens with interest rates. As the recording of this video, interest rates have ticked up over the last 2 weeks. By the time you watch it, maybe they tick down. The interest rates have been, very volatile. Again, given everything that's happening within the Treasury market, you look at what's going on in the stock market, things have been bouncing all around. My assumption is that while the federal government has promised lower rates, they've promised to lower the rates 3 times this year. Don't be surprised if that doesn't happen. You'll have to watch my other video where I cover the 7 things that investors need to be aware of. I go into further detail. Again, that's not my opinion. This is the facts of what's going on in the financial markets, and I share more details there. But interest rates, rental rates were coming off historic gains. They were pulling back for a minute. Now they seem to be edging up. That's a positive thing. That means, there's demand, there's less vacancy. So investors feel optimistic that they can raise their rental rates. But for many of you watching this, you saw that I mentioned 1%, let's say, increase in Los Angeles, 3% increase in Riverside. That doesn't mean raise your rents by 1%, 3%. Most of you watching, I would have to guess, if you own in the areas that I just covered, or you just own anywhere, it doesn't matter where you own. Many of you are too conservative with your rental rates. You've been too conservative with your rental rates. Many of you probably were caught flat-footed by the inception of rent control. So you should be raising your rents to the maximum every year. What's that maximum? Well, it depends. Does your local city have an ordinance? If you're not sure, probably want to call the housing department in the cities of which you own to ask, hey, do we have a local rent control ordinance here? Many do. You'd be surprised. But if you don't, then you're under statewide rent control here in California, and that's 5% plus the change in CPI. Here shortly, we're going to get the new readout. Remember, that change in CPI is April over April from the previous year. What was the difference or change in inflation? That readout will be available in May. In May, you get to find out what happened in April, and that'll tell us, okay, for the next 12 months, what are our rental increases going to look like? On average, here in the areas that I've covered today, you've been somewhere around 8.8%, 5% plus 3.8. But again, that soon will be changing. We'll have to see what the new readout is. This year is off to a much better start than we had last year. Rental rates are still strong. Vacancy is still down. And I would say overall, investors are more optimistic about the market. Of course, there's many things, coming down the pike, not to mention that it's an election year. Not to mention that here in California, we might soon have vacancy control. You have to see my video on that. So again, just stay in the know, stay plugged into this channel. We'll be sharing with you all the updates as they come along and the things that we believe you need to be aware of, or those things that we're counseling our personal clients on. What is it that they need to be aware of as they're making decisions to buy, sell, or hold? What are the things that they need to be contemplating? Stay here. If you have not subscribed to the channel as of yet, I highly suggest that you subscribe so you get those alerts when we release the newest videos. Share this video with the landlords that you know. On my channel, there's hundreds and hundreds of hours of free educational content that necessarily doesn't expire, especially when it comes to the tactical things of being a multifamily investor. These things are time-tested and are still as relevant today as they were, even if I record the video a year, 3, 5 years ago. There's everything here, a little bit of legal, financial, even property improvement. If you have not had a chance, peruse my channel and give this video a like if you found it informative, helpful. If you'd like to see more of this type of content, that gives us the feedback we need, and it helps get this information into the hands of as many landlords as we can. You notice you watch this entire video, there hasn't been one commercial or one ad because we don't monetize our videos. I put out all this information for free because I want to be in lockstep with the investors, being an investor myself, a landlord, and I want to assist in that way. Until next time, this is Kris German, the apartment dealer, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.